Hello and welcome to our first edition of Fixed Income Markets. I'm delighted to have with us Francesco Castelli from Banor Capital, based in London. He will be our regular guest commenting and analyzing financial markets. Francesco, welcome.
Thank you for having me, Marcello.
Sure. You can see that Francesco is based in London and is an expert both on the credit market and the wider fixed income market. So, Francesco, why don't you take us through what has been happening since the beginning of the year?
Yeah, it's been a strange year. We started on a very positive outlook for the fixed income market. Actually, the fixed income government market was kind of had a very tough year at the beginning, especially in the US, where the average loss for US bonds is 5%. Was kind of so-so for spread products like Italian government bonds and corporate investment grade. Was a really good year of credit with a corporate high yield and especially subordinated financial bonds doing really, really well. Taken from the fixed income market. These are the number of cuts that the fixed income market expects for the year. At the beginning of the year, as you can see, in January, we were expecting maybe 6, 7 cuts, both from the Federal Reserve and the European Central Bank. Over time, though, this expectation has been repriced constantly, but much, much higher. So we now see much less cuts going into the year end. And this is especially true for the United States. You can see over the last month, the two lines, the cuts expected from ECB and the Federal Reserve, they were moving in tandem for the first few months, but now they've diverged. The ECB continues to promise that they will start cutting in June, whereas the Federal Reserve now, we don't know. Powell said we don't have confidence in cutting rates.
So a
On the
very
next slide,
sure.
yeah,
So a very changed scenario since the beginning of the year.
yeah, exactly. And as you can see, this is the picture right now where the market sees central banks moving over the next few months. You can see the green line for the ECB. They will start cutting probably in June. You see the line is moving down, and probably they will land in December around or slightly above 3%. The situation is very different in the US and also in the UK, where probably rates will still be around 5% for the end of the year. And of course, this scenario has been very supportive for the US dollar over the last few weeks.
Absolutely.
Um,
What about
why is
inflation? What about inflation?
that's the reason why the Federal Reserve is so stubborn, because as you can see, their official target is the so-called PCE deflator, which is the cleaner measure for inflation. And as you can see, is moving down to 2% really slowly, too slow probably, but is moving in the right direction. The big problem, according to the Federal Reserve, is that if you look at the single components inside the PCE deflator, there are service inflation, which is still too high, sticky. And then you have this component called the CPI supercore, which is the summary of endogenously generated CPI pressures. And this component is moving upwards. So that's the reason why the Federal Reserve knows that if you want to bring inflation down, you need to slow down the economy. And so you need to keep rates higher for the moment.
Sure.
Let's move to credit. This is the chart of European high yield spreads and US high yield spreads. Slightly different scale on the left and the right, but as you can see, they can move. They moved in tandem for many months. Two things we can see from the chart. The first thing is that the rally in European high yield is probably taking at least a pause of a few weeks, and so an inversion of the trend. And the second thing is the divergence, once again, between the US and Europe. Of course, the economy in US is notably stronger. In Europe, we also had a few large accidents in the credit market, with 3 large issuers in the high yield market asking for a renegotiation of the debt. At the moment, we are treating it as a idiosyncratic factor for overly leveraged companies. The big problem, however, is this attitude of asking for a renegotiation spreads to other issuers. This might become a much larger problem for the credit market in Europe. And that's the reason why at the moment we're very prudent and selective on the high yield component of the fixed income market.
Sure.
Another trend we still like, and a trend where we are overweight, is the subordinated bonds issued by banks and insurance companies. Here we show the spread of lower tier 2 banks, so subordinated banks, and we show the spread of industrial corporate bonds, triple B. So same rating, but investment grade banks, subordinated bonds issued by investment grade banks, they offer a spread which is much higher, has been much higher over the last 15 years. In the next chart, we can see exactly the difference between the two lines. And as you can see, from 2009 to today, banks have systematically offered a much better spread. The reason, well, it's obvious. Great financial crisis, then the sovereign credit spread crisis in 2011. There has been plenty of reasons to believe that European banks were riskier than industrial corporates. However, we think that over the last 10 years, banks' balance sheets have become much better, much stronger. And over the last 2 years, we've seen also banks started to make a lot of money, a lot of earnings, so making their balance sheet even stronger. So we think that they've gone through many tests, they've finally graduated, and they are back probably where they were in 2007, being stronger and safer than the rest of the economy. And that's our conclusion, right? With the spread, which is still much higher, we see this divergence between banks and corporate bonds gradually narrowing. And so our first target is the orange line in your chart, which is the bottom of the range for the last 10 years. But over time, we think this extra spread paid by banks will completely move towards zero.
Thank you very much. Just to be very clear, this is obviously an educational program mainly. So as per our disclaimer, we have no commercial agreement with none of our guests, and we do not intend to give any investment recommendation to our audience. This is just the view of Banor Capital, but the program and the video is mainly educational. We have to say that to be very clear, because it's mainly related to an audience of students. I remind you that in the class at Ca' Foscari University today, Thursday, we have the pleasure to have Amundi. We'll discuss the asset allocation process, Mr. Francesco Sandrini. And tomorrow we have another Italian giant, Generali, a European giant, Generali Asset Management. They will discuss factor and thematic investing. We will also have Mr. Castelli coming and giving lessons, a lecture on the wide fixed income market. Later on, we will advertise that. We continue to offer internship opportunities. So for any of these events, the events at Ca' Foscari, where I am an adjunct professor in the course, or the internship, or the many other events, write to us at academy@mercurypartners.net or visit our website, mercurypartners.net. Francesco, thank you very much. Thank you to Banor Capital, and we'll see you firstly in the classroom and then in the next edition of Fixed Income Markets. Thank you.
Thank you, Marcello.
Bye.